we have all been kind of bombarded, I think, over the last few years, I would say, with news flows, which has ensured that risk has become more common in our vocabulary today than it had probably been in the last decade. We have seen multiple geopolitical flare-ups across the world. We have seen, like Ashok mentioned, tariff on tantrums from US with its partners. So all of that has meant that the risk has become a lot more common recurring theme in all conversations. So what we thought is that we would kind of run through investments and try and view investments from the perspective of risk and assess what it means for the current for the way that we look at the environment today and going ahead. So at the outset, I think what I would want to kind of cover in our in the commentary, in the opening commentary, is largely that around some broad areas of risk that we see, and notably macro risk, but in particular, I would try and kind of give some thoughts around the global and domestic macro risks that are prevalent and are topical at the current juncture. I would also want to talk about a few other types of risks which are relevant which I think are relevant, might be relevant for investors to keep an eye on. And finally, to kind of take you through some of the asset allocation and hybrid strategies that we run at HDFC and in general, the mutual fund community as a product suite, we have those and how they can be effective in managing some of these risk outcomes. At the outset, I think risk as a term obviously has got very varied connotations. I mean, in general, it can be interpreted in multiple ways. At a very broad level, it is anything which has to do with some unpleasant outcomes. And in particular, when you kind of look at risk from an investment parlance, even there, I think there are different camps who view it in a different ways. Some people believe that it's the uncertainty or the volatility in outcomes which kind of drives risk. Others believe that it is actually it has to be defined more narrowly as a permanent loss of capital, and hence that's the way they look at it. But whichever way you look at it, I think it's fair to say that there are multiple sources from which risk can emerge in a portfolio of investments. And these sources, I think, I have kind of listed down some of them. They're obviously not exhaustive. I'm sure there are many more which one can think about. And it is equally true that these in themselves are also not unique, right? There are a fair amount of overlaps between the risks that I've highlighted here as well. But what I would want to kind of point out or draw your attention to is that at a very broad level, I think if one were to think about risk, there should be two broad classifications. One are those set of risks which can be to some extent diversified away. And I think on the right side, we have tried to mention some of those kind of risks where diversification across products, across assets, diversification across securities can help mitigate some of the risk to some extent. And on the left-hand side, we have tried to come up with some risks which may not be necessarily be easily diversifiable in the sense that they might be a little bit more, many asset classes might be kind of prone to such risks at any point in time. And hence, I would try and concentrate my commentary to around those risks, particularly those highlighted in the screen here. And I would try and take you through some broad thoughts around some of those risks. Macro risk is, of course, something which is very, which is at a very loose level defined as something which is more systematic and which can kind of affect a large, an entire market to some extent. But like Ashok mentioned at the onset, it is obviously different asset classes, even to the same macro risk, can behave very differently, and hence to that extent, diversification would help mitigate some of the risk associated with the macros themselves. And at the same time, I think macro is something which one can look at it in different time frames. Different kind of risks can become more prominent. And hence, to that extent, it is a bit contextual. And hence, today, what I would look to cover is some of the topics which we keep getting or hearing as top of mind for some of the investors. And I would kind of split it up between global and domestic. On the global front, I think it is. I mean, I don't want to spend too much time on this because clearly, I think most people appreciate in today's world, things have changed quite dramatically from what they were probably for the past 20, 30 years. I think it is the first time that we have actually seen wars being fought. I mean, hot wars being fought. I mean, we obviously exited the Cold War era a long time back, and since then we have had a very peaceful, I would say, time for the most part of the last 2, 3 decades. And hence, this is a relatively new experience that most of us are getting acclimatized to. And so geopolitics is clearly one big area which has kind of seen a flare up. And tariffs, like I mentioned, I think it's something which is at the top of mind for most people. And what it means is that a combination of these has meant a very big change in the way trade patterns across the world have emerged. And there are clearly reorientation of supply chains which are happening real time. And it also means that the overall capex sentiments across the world has kind of taken a bit of a beating because of these developments. Uh, so, so in a way, I think both of these have been causing some downward pressure on global growth and at the same time putting some upward pressure on inflation. And this is a combination which is not generally considered very healthy. I mean, in most cases, I mean, you would hear the terms recession, stagflation. I think these are risks which become prominent when this kind of a combination of low growth and high inflation kind of plays out. So that's something which one needs to keep an eye on because this is a risk, particularly in the developed markets. This is a risk which has been highlighted more often now by renowned commentators, and hence one needs to pay attention to this risk, and it needs to be kept in mind while assessing any form of risk, even for the domestic equities. As far as India is concerned, I think we have a few mitigants, particularly towards some of these risks that are highlighted from a global front. And notably, I think what is clear is that we have, relatively speaking, amongst the emerging markets, we have relatively low export share, and that makes our growth drag relatively less compared to the others because of global trade getting impacted. The tariffs or the potential tariffs, reciprocal tariffs that have been talked about, I think we are not at the extreme end. So we are somewhere in the middle, which means that we have some maneuverability even there. And more importantly, I think from a balance sheet standpoint, if we look at Indian balance sheet, either at the government side, households, or on the private sector side, they seem to be fairly strong, robust. So that puts us in a relatively good shape. And when we look at our growth projections, even going ahead, I think we are still in that 6% plus clip, which is a fairly decent number when you compare to the global numbers of 2.5%, or the emerging market numbers of 3.5%. So I think all in all, global risks are obviously very important, and I think I mean there are no two ways that it does impact every market, and it will probably have an impact on Indian markets as well. But hopefully our ability to tide through this risk should be slightly better compared to some of the other peer markets that might be more exposed to this form of risk. Coming quickly to the domestic side, I think there are multiple risks on the domestic side, and I'm not sure whether I can be totally comprehensive in covering all of them, and I'm happy to take a few of them in the Q&A as well. But I think some of the topical issues I would try and quickly address and kind of take you through those risks and what are the mitigants that we see in the current market environment to kind of address those risks. Firstly, I think external account is something which has been talked about, and in particular, I think capital account is something where people have some amount of concern. Traditionally, it has been the current account side which has bothered us as an economy. But today, as we stand, I think on the capital account front, we have seen that both on the FDI side and on the FII flows side, we have seen, I think last 1.5, 2 years have been fairly weak. So on the left side, you see the FDI flows chart. I think this has been a very steady kind of a flow for us. Historically speaking, it has kept growing along with the economy. But in the last two odd years, we have seen a very sharp dip in the net FDI numbers in India. And this is partly a reflection, this is more a reflection of repatriation rather than the gross flows. So because a lot of capital has been pulled out of India by some of the, some of the promoter groups or foreign MNCs, and there's also a reflection of the valuations that they felt that some of the market valuations for some of their entities is good. So they have kind of pulled out some money. So that number has been fairly muted. So that's one area of concern. Another area of concern is, of course, FPI flows. I think we have seen last year was a negative number. And even this year, financial year FY25, it has been a very sharp. First 2 months were very sharp in terms of their outflows. Obviously, the subsequent 3 months we have seen in March, April have been positive months from an FII flow standpoint. But this clearly remains an area of concern, the capital accounts. But the good news is that as a mitigant, what we find is that our current account situation is now much more reasonable. I mean, it's very well controlled. And now with crude prices hovering around the levels that prices that they are, I think we can. I think we are reasonably sorted on the current account side, and we have, of course, reasonably good forex cover. So all in all, I think our on the BOP front, we may not be as exposed. The concerns might be, I think, relatively less at this point in time. The other concern that on the domestic side, which keeps getting highlighted, and it is reasonably valid as well, is the overall fiscal position of the government and how they can kind of continue to spend on the capex front. Because one of the key stories and one of the strong areas that we as a country have done very well in the post-COVID environment has been the capex front. We have seen a very strong improvement in our gross fixed capital formations. We have seen, particularly on the government side, the spending has gone up quite substantially. And all of this has largely been aided by a very strong growth in the revenue levels, and particularly the tax revenue collections for the government. We had seen last few years it was growing at almost a 20% plus number, and that has helped a lot in being able to drive capex growth at those 20% plus levels. Now, what we are seeing is that this growth is clearly moderating, particularly the tax revenue collections. I think what you would see now on the left-hand side table is that for FY26, the budgetary estimates on the tax collections, overall, the tax revenue growth is more like 10-11%. And this is also getting translated, of course, in terms of capex growth numbers. So the budgeted capex growth numbers are also some kind of seeing more flattening bias. So if you look at FY24 numbers of our overall capex, and FY26 numbers, they are more or less similar. So that is one area of concern which is there, that if given that our revenue collections are moderating, how can government continue to kind of spend on capex as much as they have in the past? I think the mitigant that we have on that count is one. I think firstly, I think on the revenue front itself, with some of the global commodities kind of coming down, particularly crude is a big important component of it, that provides some cushion on the fiscal front, and hence some of the subsidies for other things also might kind of be relatively lesser. So that gives us some cushion on the fisc side. And more importantly, I think while much of the heavy lifting over the last 2-3 years have been, or the last 3-4 years have been by the government, I think it is time now to expect that some of the capex burden should kind of move. At least the growth burden has to move to the private sector side and the household side, which is the real estate. And we have seen incipient signs of that play out. We have seen real estate cycle kind of improve quite well. We're seeing inventory levels, real estate inventories come off. While, there has been some moderation in sales in the recent past, but this is something, if the cycle continues, I think we can see some capex continuing on the household front. Even on the private sector, the good news is that while it is still very early days to clearly call out a cycle, but at least the FY24 numbers in terms of growth was reasonable, and same holds true even for FY25 in terms of the private sector capex. So, but this has to obviously continue to pick up, and hence we would keenly watch out for those signs, and hence we would not be too pessimistic on this count, and would be hopeful that some of these things kind of play out over the next couple of years. The third area of risk, which has clearly been highlighted, at least on the domestic front, has been the earnings downgrade. And this we had seen after a very prolonged period. I think, almost for the entire of post-COVID period, we had been seeing only earnings upgrades. And this was the first year, FY25, where we had started seeing earnings downgrade play out. And if I look at it, in this table, what you would find is that we have kind of classified Nifty 50 at the mid cap and small cap, and how the earnings for FY25 and 26 are kind of how much cut they have seen. Large caps have seen anywhere between 5% to about 7-8% kind of a cut for FY25, and a similar number for 26. The cut for mid caps and small caps have been higher, particularly for FY25 at almost 10-12%. So this is clearly been one area where I think some of the bullishness of the past 2 years of earnings estimates being strong had flown into the numbers in terms of estimates for FY25 and 26 as well. And given the moderation we had seen in an overall, I would say, economic environment, that has kind of translated into a meaningful cut in earnings. Again, here the good news, the way I see it is from a mitigant standpoint, the risk of downgrades has clearly moderated. Particularly now, if I see the current earnings season, the earnings cuts are much lower. Obviously, the earnings season is still to get over, but I would imagine that the pace of downgrades has probably peaked, and now we will see some moderation in the pace of earnings downgrades. The other thing is that we are seeing incipient signs of consumption improvement, and this has been one big pain area for us as an economy, and from a market participation standpoint also, a lot of the consumer sectors have seen very weak numbers. While in numbers, it is still not getting meaningfully reflected, but at least the hope is that the next 1 or 2 years should see some improvement. And this is largely premised on the fact that we have seen some actions from the government side, particularly on the personal income tax cut that we had seen, particularly for the middle class, which should come into effect from the next financial year. We would also see the pay commission payouts, the 8th pay commission payout for government employees kind of come through in 27. And we are seeing, for the mass consumption side, we are seeing various state governments rolling out various incentive packages. So all of this means that mass consumption should hopefully bottom out and start improving. Obviously, the urban or discretionary consumption might still continue to kind of lag. And this is an area which needs to be washed out, but that is some area where we would be keenly watching out to see if there are any earnings improvements on that count. And finally, the third area where I think earnings cut became accelerated in the last year was also because there was meaningful delay in government spending, particularly linked to the election side, so which was most of the earnings cut that we saw on the capex front was also partly driven by the lack of order flows and the lack of payments from the government side, because of the first half of last year was very election focused. Which hopefully should be in the base now, and that should drive some moderation in earnings cut going ahead. So these are some of the mitigants, but clearly earnings is something which needs to be closely monitored, and this is one risk which is on the fundamental side very important. If this market has to kind of stabilize or improve from here on, I think earnings has a big role to play in that. The fourth area of risk, which I want to kind of quickly highlight, is the overall sentiments. I think what we had seen for the past 3-4 years was that sentiments in general in the market had turned extremely bullish. And that is never a good sign as far from an investment, from an investment initiation standpoint. What we saw was that the leftmost chart, you would see there has been a very sharp spurt in the retail activity in the marketplace. And the F&O volumes very sharply increased, and retail participation in F&O increased very dramatically. In the middle chart, you would see that broader markets kind of saw a much better performance versus narrow markets. So any index that you see, which is a mid cap, small cap, or NSE 500 indices, or even broader markets, generally they tend to outperform the Nifty by a very wide margin. And whenever that happens, that means that that inherently means that there is a lot more optimism, and sometimes a lot of speculation also creeps into that kind of an investment. And finally, on the last chart, you would find the large number of offerings or supply of securities that we saw both in the primary and secondary markets. So we saw that there was a large number of issuances in terms of IPOs, OFS, secondary market offerings. It's also linked to the point that I earlier made about net FDI, where some of the promoters sold off, MNC promoters sold their stake. So all of that meant that the valuations had kind of, the market had become a little bit frothy. The valuations had become a little bit high. And hence, to that extent, there was, I would say, some amount of risk which inherently crept into the market in terms of investments. What we find now is that as a mitigant, we find, regulator did take some action on the retail participation front. We have seen some of the market volatility and some of the participations on the retail front come down, but particularly on the F&O side. We have seen sentiments overall, I think, have moderated. I mean, when you see now the broader markets have started kind of underperforming the narrower markets of Nifty, which means some of the frauds which had built up in many, many pockets, now I think they are left in very select pockets. I mean, it's not as prevalent as it was at that point in time. And we are also seeing a commensurate fall in the overall primary and secondary market activities. So the number of IPOs have started moderating, and secondary offerings have started to moderate. So I think all of these are good news because as investors, as long-term investors, what you don't want is that markets to get into bubble territories. Then it becomes very difficult phase for you to kind of come out of it. Because if the markets drop off sharply, the sentiments impact can be, again, very extreme on the bearish side as well. So you want some balance in terms of overall sentiments. And I think that sentiment balance is now kind of playing out in the marketplace. Overall, I think the last risk that I want to talk about is, of course, valuations. I think this is a very well-known aspect of market, and this is the most quantifiable aspect of market as well. I think most of the macro risks that I talked about, many of them cannot, they're individually quantifiable, but their linkage to markets is relatively more diffused. But particularly when you talk about valuations, it's more easily quantifiable. Even now, today, as we stand, what we see after the corrections, what we find is that the large cap valuations are about 10% higher than long period averages. The mid and small cap are still about 25 to 30% higher than long period averages. And that's where we stand today. So while it suggests that there is still some amount of overvaluation left in the marketplace, I think it does mean that it also means that at least on the large cap side, the valuations are starting to get closer to long period averages, and hence to that extent, they are relatively more acceptable today versus earlier. The key mitigants here, I would think, are that first, of course, the bond yields, overall G-Sec yields in the country have fallen, and that clearly provides some level of comfort because on a relative cost of equity basis, I think market valuations look relatively more acceptable when bond yields are lower. So the earnings yield bond yield ratio and such kind of measures start to make a little bit more sense. The other area is, of course, that if earnings growth continues to grow, if not at high teens, but at least in low teens or high single digits, I think even low teens, probably 10 to 12, 13%. And you have some time correction in the market the way we are seeing currently. In 6 months to 1 year time frame, markets again start to look reasonable. So to that extent, I think we are in that phase where I think I would be more inclined towards believing that it's a market consolidation phase, and we are probably obviously, one cannot rule out sharp drawdowns, but the better outcome for us as a market would be to kind of consolidate for some time before we start kind of moving up. So that's largely on the market risk side, a macro risk side. I think those were relatively more contextual and related to current environment. A couple of risks that I also wanted to talk about quickly, and here is again where I think asset allocation and some of the hybrid products do kind of play a critical role, and it becomes important in the current context. One of those kind of risks is horizon risk, I think, or timing risk. I think these are all very related concepts. Timing, volatility, all of those are related concepts. I think what it means is that if a certain investor has a very long time horizon in mind, but because of certain events that have panned out in his course, he has to shorten his investment horizon, then you're exposed to the risk that you have to kind of take out money at a time when you were probably not planning to do so earlier. So in this kind of environment, in this kind of things, I think having a relatively low volatile portfolio helps a little bit more. And in particular, in volatile times, it matters a lot more. This timing aspect of entry and exit becomes a lot more critical. And this is where I think some of the asset allocation products are fairly useful in reducing this kind of a risk. What you would find in the chart on the left is that if you see what we have done is over long time frames, we have mapped basically rolling 1 year and 2 year returns over last 25, 30 years. I mean, these are daily rollings, so there are a large number of data points here. And what you would find is that the equity which sits at the bottom end has almost got a 10% kind of a probability of having a negative return over a 1 year period, over a 2 year period. When you come down to some of these asset allocation products, which is whether it's a 15% equity, 85% debt, or a 65% equity, 35% debt, or anywhere in between, you can add gold to the mix or any other commodity to the mix. That makes it even better. What you would find is that in all those cases, the outcome becomes dramatically better in terms of 1 year time horizons. The number of negative return periods reduces very substantially. And this basically reduces the risk that you have to kind of have a very poor exit or a mistimed exit out of your portfolio. And this reduces, hence, the timing risk or the horizon risk in your portfolio meaningfully compared to a pure equity as an asset class. And this is where I think these kind of products step in. And this is more relevant, like I mentioned, in volatile times than during times when it is a secular kind of a market situation. On the right-hand side, the same thing kind of is illustrated over a medium to long time horizon, which is about a 5-year, 10-year time horizons. This is over a 10-year period. What you would find is that the gap between the minimum and maximum outcomes of over a 10-year time frame can be very big in terms of equity. That range is almost 5x. Whereas when you come to some of these hybrid products, you would find that this is more like 1.5 to 2.5 times. So your volatility in outcomes, even over a 5-year, 10-year, becomes meaningfully less in when you stick to an asset allocation kind of a product. So this is in the context of horizon risk. And the other risk that I want to quickly touch upon is inflation risk. I think this is, again, most of you are aware that all said and done, you can't be in completely safe assets, which don't even account for inflation. So the risk of losing purchasing power over time becomes extremely important. So while equities does a great job of beating inflation, I think the risk with equities is, of course, the horizon risk that I spoke about earlier, and volatility, and hence shorter time horizons, the outcomes can be very unpleasant, can at times be unpleasant. So how good are some of these hybrid products in beating inflation risk? And I think here the outcomes are fairly decent. So when you see how these products like a 15% equity, 85% debt, and going all the way up to 65% equity to 35% debt, and compare this to about 100% equity, which is the bottommost row, what you would find is that over medium time horizons, 3-year, 5-year, 7-year, the chances of beating inflation in all these products is as competitive as it is with pure equities. So they are, in a way, I think these are all products which are designed at least are coming out with outcomes. And this is again backtested for very long time frames, are coming out with outcomes where the inflation objective of yours, which is to meet inflation or beat inflation, is getting met in almost most of these cases in a comparable manner with pure equities and with the lower volatility that I talked about in the horizon risk part. Coming specifically to HDFC set of offerings, I think we have a full basket of offerings in terms of the hybrid products. So here you would find the most conservative product that we have, the conservative hybrid HDFC hybrid debt fund, is about 10 to 25%. It invests in equities. The next product is equity savings, which is about 15 to 40% net equity exposure. But it gives you the equity taxation benefit through taking the gross equity up to 65%. Then we have in between these three products, which is HDFC Multi-Asset Active FOF, the HDFC Multi-Asset Fund, and HDFC Balanced Advantage Fund, which are very dynamic in terms of our allocations. We try and take advantage of being dynamic in the marketplace, particularly with respect to valuations, market valuations being, and we expose from a net equity standpoint, the exposure can be anywhere between 40 to 80%. The only difference between these products is that the Balanced Advantage Fund is more between equity and debt, and whereas multi-asset, both the multi-assets, which is the fund of fund and the fund, are both also have gold exposures in them. And finally, on the rightmost extreme, you have the HDFC Hybrid Equity Fund, which is 65 to 80% into equities. So all these are hybrid products, and kind of quickly to summarize how they compare relative to the parameters that I talked about, both from a timing risk and an inflation risk standpoint, you would find that their outcomes have also been fairly reasonable over long time frames. All these products, if you have a holding period of more than 2 years, I think the probabilities of running negative returns have been reasonably low. I would say in low single digits. And that is an outcome which is, I would say, reasonably acceptable. And on inflation measures as well, on all three time horizons that we have considered, which is 3-year, 5-year, 7-year. Most of these products have been fairly, I would say, fairly successful in beating inflation in all these time horizons. So I think, so to kind of summarize or to conclude my comments here, I think what we see or how we perceive risk is that we are generally more concerned about risks which cannot be diversified away, and hence because by definition we consider that most investors today would not run very high concentration risks, and particularly at least in the mutual fund offerings, we have very diversified offerings, and hence to that extent we are more concerned about risks which impact even diversified offerings. The macro risks are something which cannot be wished away. They're clearly very much present, and today's environment is probably more present, particularly from a global standpoint. But here what helps us is, of course, the valuation discipline. I think sticking to valuation discipline and ensuring that you're not in very mispriced assets will ensure that even when things go wrong, hopefully the fall in prices is not very stark or dramatic. At high valuations, obviously the risk of market mispricing it, and hence the ability to digest bad news is that much lower. And finally, asset allocation over time will helps basically take care of both the timing risk and the inflation risk that I spoke about. So we would kind of conclude with that overall the risks are something which the idea of entire investing is that we should be looking to manage risks and not to avoid risks, because risks are clearly not avoidable. And the more we try to avoid risk in general, we would generally tend to be too safe, and that would of course bring in the inflation risk into picture.
With this, we will close this call. Thank you, Srini, for your time and a fantastic presentation, and Sangeet for your moderating. Thank you, guys. We can close the call.
Thank you, everyone.
Thanks, Sandeep, and thanks everyone on the call. Have a good day.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.